So while officials obviously do not have any physical silver to leverage to sell against, footprints left by the same agent insiders active in the gold futures markets have been revealed.
Wow, there seems to be a lot of movement and a lot of news in the whole gold industry, the wholesale gold industry. Now, let's talk about. You just mentioned silver. Can you update all of our live from the vault silver fans out there and stackers on what you're seeing, what you've seen basically over the last couple of weeks now?
Yeah, this is huge. It's perfect, Shane. This is where the smaller silver market provides us advance notice that the COMEX price setting mechanism has actually already broken. The same actors' footprints in the direct related, more visible, smaller silver futures market really underscores this unprecedented fracture of the two divergent global price setting markets. So I want everyone to mark this in their calendar. What we witnessed on Wednesday, July the 6th, I want you to mark this in because this is when the silver market hedging mechanism finally broke. Now we'll look at this in a little more detail in a sec, but it's significant as this foreshadows the same is about to occur in the much larger global price setting global COMEX gold futures market. So while officials obviously do not have any physical silver to leverage to sell against, footprints left by the same agent insiders active in the gold futures markets have been revealed. Now, while specs are holding the bulk of the short load in silver with the commercials on the long side, there's far too much in the way of official gold supply being sold to be able to lay it off on these speculators. So the spillover will leave a massive paper to physical gap to fill. So yes, Shane, to elaborate, your silver, of course, looking at the same actors' more visible footprints in silver, 4 trading days into the G7 instigated wall of gold selling, which reflected on silver, and that was on June the 30th, under the radar of most futures markets traders, the July silver contract rolled off the board into delivery, whereupon we observed that the silver market had moved into such a deep arbitrable backwardation that it had bled unresolved into the further out September contract. We'd already hinted at this in our last episode, but now what it's done is expose an unprecedented, exceptionally large $1,400 per contract backwardation in September silver. Now, if you're an insider, you're all over this, because the speculators don't see the cash market. They just see a dot on the screen in the COMEX. In fact, they're forbidden from trading in the futures market, in the spot markets. As we said before, I had to get rid of all my US clients in 2013. Anyone that was basically wanting to trade over the counter was forced to trade the version of it in the COMEX. Now, the reason Wednesday, July the 6th was so important, this was when the silver futures market finally broke to such a degree that it can no longer be relied on by liquidity providers as a legitimate hedging mechanism. The COMEX silver market is broken. There is no other description for it. And looking at the data, and for those people that are interested in the data, it's impossible to ignore this massive Wednesday, September 21.7 cent backwardation. Hold on a minute. We're talking about the September contract trading at 21.7 cents cheaper than the cash market. Now, this is huge. Now, if you add in the carry costs for the forwards to carry this contract over to the September contract expiry, that ramps it up to 28 cents. That's equivalent to $1,400 discount per contract. There is just no hiding this. Was an EFP fracture. And since then, we've witnessed persistent between 7 and 13 cent plain vanilla backwardations into technically deeply sold conditions. Now, this is a reversal from the norm because we normally expect silver futures 15 to 20 cent premium to spot, which obviously that legitimizes it as a silver as a hedging instrument. Same with gold. You expect a higher price in the futures market so that you can take your position, your physical position, your long positions, your derivative positions, and hedge them in the COMEX for a slightly higher price. Now, these unheard of backwardations completely nullify COMEX futures contracts as a viable hedging tool. This is huge. The EFPs in SI, silver futures, are so divergent that COMEX inventories are being sucked out of the COMEX for delivery, making it far more difficult to incentivize more spec-related paper selling traction into obvious insider buying. Now, because there comes a point, even though they have more chips to sell into, it's starting to get very, very tight. Now, this unprecedented degree of COMEX Sentry underpricing versus the cash price versus September and even December futures contracts underscores that the COMEX futures contracts are no longer a viable benchmark to hedge physical or long spot positions held by market making liquidity providers. And they want somewhere to hedge it. And this is especially relevant as paper discounts are flowing into very strong Indian and Chinese physical demand. Now, notably, liquidity providers report that cash silver also went into technical backwardation with a December contract by midweek last week, really spooking liquidity providers. These are conditions even more divergent than when we evidenced the EFPs fractured in March 2020 that triggered an $18 short covering rally. So, there's a difference between the net short position between the commercials and the specs, which we talked about in May 2019, to an exchange for physical disconnect. Now, very short term, blinkered to the cash market disconnect, speculators continue to chase this bearish momentum, continue to chase it, utilizing their short profits to double down, get some more chips, double down on these bearish bets. I mean, you're chasing something that is just a dot on the screen. And it's resulted in an unprecedented disconnect that when, not if it can uncoils, but when it uncoils, it will be violent. And once liquidity providers lose trust, as they did in March 2020 in gold, when the EFP to spot market broke, forcing these liquidity providers holding spot longs hedged on the COMEX to lose hundreds of millions in just a few minutes, all but the 4 insider banks listed in the OCC report, you can go look at them, who they are. We know who they are consistently, now hold 95%. In fact, we looked at it with Robert Keynes last week. They're holding 95% of all the silver derivatives contracts. All the others have exited this space. And as we reported back at the time, we witnessed the exit of most European second-tier bank liquidity providers, and this market depth liquidity has just never, ever returned. Now, understandably, having been caught out once, even plain vanilla liquidity providers who are just providing very short-term liquidity and there are dozens of them, but these are not the market-making banks necessarily. These are just the liquidity providers really watching each side of a spread, making sure they have the physical to back it up should they get turned upon. They become very wary of making markets in this 10 times larger foreign exchange gold market. Again, following being unexpectedly turned upon for physical delivery of unbacked gold positions hedged on the COMEX once before. So trying to exit these physical delivery calls, if you remember, that it just snowballed them en masse. They were called on their short hedges, which forced the COMEX to go bid only, driving $100 spreads. Look, these are that was the evidence of a crack that was quickly papered over. This time we have a market, a physical market that isn't just relying on a COVID lockdown. This is a physical market that is in huge demand, and you cannot stop the Russian gold or oil discount. And there's more on that in a minute, but essentially with spot gold foreign exchange positions now Basel III NSFR compliant, which is so important to understand, which speculators do not understand, the market-making agent banks only have one non-compliant backdoor to square this EFP gold as it's flowing out of the COMEX, and that's GLD. But as we've just outlined, given the current EFP drain into this SIOT gold outflows, all EFP gold currently landing in the FX gold markets is resulting in EFPs translating into COMEX draining physical deliveries. Now, while this wall of G7 mandated COMEX-centric US-driven official paper gold selling has deliberately flown under the mainstream media radar, oh yeah, we're down because of bond yields, oh, because strong dollar. That's rubbish. This is an official sell program. And the related, equally ill-advised but newsworthy Russian oil price capping mandates that were discussed at the same time are also headed for a major blowback. And as per JP Morgan, you'll probably all saw JP Morgan's prediction. Yeah, guys, if the oil prices could surge to $380 a barrel if Russia decided to slash crude production in response to these G7 sanctions to cap the country's energy prices. You couldn't make this stuff up. Can you imagine what gold will be like at $380? These guys have both sides coming in on them. This is a complete circling of this short position. Now, our first tier liquidity providers also confirmed to us that the non-compliant, the non-Basel III compliant COMEX-centric selling has been official. However, the wall of paper gold selling reached extremes last week and into this week too, dislocating the exchange for physicals to actionable levels not seen before the EFPs fractured back in March 2020. So bottom line, this is a huge backfire in the making, especially as physical gold supply is tightening as central bank, sovereign, and a massive tripling of Indian smuggled gold to feed the gold for oil discount window into a very ill-conceived Fed attempt to water down the paper gold price is increasing the leverage of paper gold to unsustainable, increasingly evident backwardated levels.